and welcome to the Digital Digest, your weekly breakfast of insights, tips and tricks, and general information that will help anyone trying to move things forward in this digital world of accounting. I'm joined today by Paul Surtees from Capitalise, and we're doing something a little bit different. We're actually going to talk about the economy to some extent, and at least the impact that the probably now world famous Trump tariffs are having on global trade and the UK in particular. So look, Paul, this is a huge topic. We could be, we could talk about this for days, weeks, months, as I'm sure a lot of commentators are doing it. We only have half an hour. So let's start with a bit of a summary. Where are we at the moment with what Trump is doing with his tariffs?
Hey Ryan, it's great to be here. Thanks for that question. I think that look, the first caveat I'm going to put out there is, of course, information and announcements are moving so quickly that it may not be possible for any one person to keep up with it, myself included. But the second also is that it also creates a great deal of volatility and output because it creates a lot of uncertainty. But whilst I was thinking about tariffs um, a little bit yesterday afternoon. Ultimately, Trump came in and changed everything last night by putting a pause on what he had only announced just a handful of days previously. So currently, and I'm going to talk in real world terms. There's a baseline 10% on all imported goods into the US. The EU has an additional 20%. UK and Australia specifically, and from our perspective, we're in good shape. We've got a 10% favourable position, but I think at this point in time we'll absolutely take what we can. We are still subjected to the metal tariffs of 25% on steel and aluminium. And of course, the big one that's out there is China is at 125%.
Yeah, it's crazy, isn't it? And I know the tariff on the steel thing is definitely having an impact in the UK based on the recent announcements by the government. But before I guess we get into specifics on that side, what are you seeing as the general impact on global trade at the moment? Probably more focused around what the UK is doing, but just general international trade in general.
Well, I think actually, if I will just dig into your steel and aluminium piece, I mean, obviously there's kind of support and things going, and being talked about for various steel plants, here in the UK, and of course there's lots of jobs and it's headline worthy and it's all of those things. But from an accountant perspective, you probably don't have, or very few who may be listening will have steel and aluminium manufacturers, producers, plants kind of in their portfolios, but they absolutely will have. Construction, manufacturing, fabricators, auto makers, and so on, who are in their supply chain, and of course that 25% will have an impact for them. And so you might think it's kind of like beyond the pay grade of the typical portfolio, but it will have a knock-on effect. In terms of international trade, look, I'm not so closely associated to it, but if you think about what's happening in oil at the moment, the oil price typically trading kind of $70 to $80 over, plus or minus over the last near period, is actually going to drop down to about $60, through this kind of period. Now, that's great for prices at the pump. It's great for inputs into lots of the manufacturing and international trade that you talk of, but ultimately it's indicative of the world potentially thinking about a recession and a recession coming. And so, but it could also be reflective of ships moving less stuff. We've only got
Yep.
to go back to the weekend and think about Jaguar Land Rover's announcement that they would not be shipping any of their vehicles to the US, and that is 25% of all of their business. So of course, it does have big impacts. It'll be interesting to see, do they knee jerk back and suddenly start exporting because we're now down to a baseline for 90 days? Because of course they don't want to lose that business, and 10% is a lot easier than what it was previously.
Yeah, and I guess a lot of it's posturing. So countries, businesses saying they're going to do something to see what the impact from the other side will be. And I assume there's same from the investment perspective. I assume there's been a lot of flux in, I guess, how global investment has been affected by this. And you were saying something to me earlier before we went live about the impact on, I can't remember, was it gilts? You something that
I
you
was talking about
referred
the
to.
treasury market.
That was it. Yes, sorry.
So, I mean, just going up one level at this point in time, I mean, the market volatility has been heinous. There's been some huge swings. In a positive swing yesterday, we had, one of the largest moves in 20 plus years in like the Nasdaq and the S&P, as it had a bounce after he came in and put a 90-day pause on, because obviously he'd kind of settled everything down at that point. But that volatility is very, very difficult to manage. And your question about treasuries, US treasuries, the equivalent of UK gilts. It's how the US government funds itself. It is the largest, most liquid market in the world, 27, $28 trillion in terms of size. Um, just 2 days ago, they came to market in an auction to put a bond out, a 3-year bond, to raise, to keep the US engine moving forwards. And actually, it didn't go particularly well. It wasn't a failed auction, because that would be catastrophic, for a US auction to fail. But kind of word on the street is that the international participation, i.e., non-US buyers, actually shrank from 19%. Of the auction to just 6%. So that's a really big shift. There's some conspiracy theories out there that China is retaliating by not buying the US treasuries. And of course, that would be an issue over time, because they are the second largest holder of US treasuries and therefore the second largest funder of the US government.
Wow, this is stuff that I am learning right now, Paul. This is obviously a space I don't specialize in, but something that we do as digital disruptors is understanding change, and immediate change triggers and requires disruption, and that's essentially what is happening right now. There's a lot of unknowns. It's been very impactful. It's been very abrupt, and I guess one approach or one view to this approach might be that rather than try and do things slowly, he's gone, let's do things quickly. It's like ripping off the band-aid, right? Let's do things quickly. Let's make something abrupt, and then everything will stabilize afterwards. But I think one of the biggest impacts is that whenever I find in any work I do, um, even if there's a recession, digital transformation is usually quite popular. But it's when there's that unknown, that initial trigger of like, we don't know if it's gonna, it's going to be an upturn, a downturn. At this point, we just put everything on hold, and that's where I feel we currently are. Is that what you're kind of experiencing in the market as well?
I think that is the single biggest risk to the global economy at this moment. And JP Morgan have come out suggesting, and this is pre last night's move. So, as I said, data moving quickly. Have suggested that there's a 60% chance of a global recession. So that's a negative print on growth from a global perspective. If we look at the US, it's not always perfectly accurate, but the Atlanta Reserve, which is, each state has its own little mini central bank. It's got a real-time GDP predictor. So the Atlanta Reserve real-time GDP predictor is suggesting minus 2.4% GDP for the US as an
Wow.
outcome of what's happening. So that's a really big shrinking, because of course the reason that stock markets were so high, just a few weeks back, was because the US has just outgrown all expectations, and is absolutely, for those on the right side of the wealth divide, has outgrown all expectations. Um, so uncertainty, and that's what he's creating. It isn't just like an inconvenience. It's the defining characteristic of where we are at this point in time. And so I think that we have to get comfortable with that. And I sadly am old enough to have been through the dot-com crisis, the financial crisis. Obviously, we've all been through the pandemic. And I think this uncertainty is with us to stay. And what Trump is ultimately trying to do is to change the world order to effect, and to right what he sees as wrongs from a US perspective, obviously America first. Regardless of your views in that context, that's going to cause uncertainty.
Yeah, it does. And so let's bring this a bit closer to home. We're doing a webinar in the UK. Let's talk more UK. What do you think the short term impact will be on UK businesses, and maybe we could speculate after that on what maybe some of the long term ones. But short term, what is that kind of what's happening now? What are businesses doing, or what are they more wary of at this point in time?
It's a good question. I think that uh, if you look at large businesses and small businesses, okay, large business and particularly corporates, they've got strategists and financial teams and strat plans and 3 years this and 5 years that. They tend to move very quickly in response to these kind of events. What they tend to do is they will tap the market quite quickly for funds to make sure that they got their working capital in place. They will, go through various balance sheet discipline exercises, and we can come on to that in a bit. But I think that the small businesses tend to move much slower. So if we look at Capitalise as as an SME credit score and funding platform, if you look at funding data, during COVID, the large corporates came up very quickly, like in January 20, and started borrowing very, very hard, like outsized volumes. And then by the time March, April came, they actually came off the boil very quickly. So they funded before really we went into lockdown. Okay.
Yeah.
Whereas the SMEs were kind of like, oh my goodness, we've gone home. Nobody's buying my stuff. I'm not selling food. I'm like, and obviously there were certain pockets that worked and most didn't. And so in that context, that's when they suddenly hit the market for borrowing, bounce back, C-bills, and so on. And that's when they took 5 times as much funding. The reason that I'm kind of putting that out there as a parallel is that people will be reading it, people will be feeling it. People, I think, at this point in time will be like quite busy with the day jobs and focusing on delivering and execution and all that kind of stuff, and not necessarily lifting up their head and kind of thinking about the longer term implications of it. And it's confusing, right? Like I spent most
Yeah.
of yesterday sitting down in a quiet room, actually trying to, think about what's happening and why it's happening and what's the impact for Capitalise. What's the impact for our partners? I spoke to lenders, I spoke to accountants, I spoke to businesses to kind of get a general vibe. And the impact of that is, like I'm better informed as a result. It doesn't mean
Of
I've got the
course.
right answers. So I think you've got to get to that point where you start to think about the impact for yourself and your business in that place. But what I can say is that we can't predict anything at this point in time. We can only plan.
Yeah, agreed. And I think, yeah, it's that proactive against reactive approach. And proactivity comes with the fact that you've got the resource to be able to do that. You can hire experts, you've got the capacity to look into, you've got the ability to, and the relationships to draw down on finance when needed. You've kind of already got the mechanism set up to do that. Whereas small businesses, they just don't have any of that. They're just, they have to be reactionary because they know what they know. They know how to operate and make money for themselves, but they don't have the experts out there. They should have partners, and that's where the trust and reliability on the partners and their relationships in that side works. But that really also depends slightly on scale. If you're a one-man band, you're just going to react to the immediate things around you, aren't you? You're not going to be looking at generally market conditions unless it has a direct impact on your sales, your income, or your costs. And as we saw, like as you go back to construction, as we saw in COVID, that triggered the whole price increases, and so many construction businesses lost money because they'd got quotes out there, they were committed on that, but now their prices, their supply prices spiked, and they just didn't have the bandwidth to absorb that. But I guess if we're looking at from a steel perspective, UK, if they're not exporting out to the US, there's different markets to find on that. They might be reducing prices. They may go the other way and prices may come down. There may be more profit opportunity in that space. As you say, it's speculative at this point. But
I think actually to just add one thing to that, I was speaking to Jonathan, who's the chief economist at the ACCA last week, and when businesses, when individuals, and indeed when governments are backed against a wall, deals and transactions can happen in a way that perhaps they wouldn't. And at this point in time, as I outlined at the beginning, Australia and UK have got very preferable baseline rates, right? Like we've been, bespokely pulled out into that context. Now, King Charles, sorry, probably like grabbed his nose at the prospect of, a second state visit. But ultimately, at some point, we're going to be rolling out the red carpet and we're going to be like trying to extend that relation out, rightly or wrongly. But the point being is that one hopes that we are in a better position to benefit from this long term. We're outside of the EU. We've got a special relationship with the US. It may be at the expense of chlorinated chicken, but we may actually end up with we may end up with a preferable position, but we don't know.
Yeah,
Nobody
it's
knows.
still the unknown, still the disruption that's coming from it. And I've got to admit, I did not think we'd be talking about chlorinated chicken on this on this webinar. So you never know where it will take you.
You never know where it can
Um,
get to.
exactly. So I guess part of the purpose of this is to understand a bit of what's going out there, a bit of what what we should be aware of, but also what we should be considering, what we should be doing. So for those accountants out there, actually, let's start with businesses. But for those business owners out there, what do you think they should be considering? You talked about working capital of larger organisations. I should assume they should be considering the same thing. Like, do they have that buffer, that runway, if something does happen and there is an adverse market reaction to this, that they can still continue and absorb that? Would that be a fair assessment?
100%. One of the accounting firms I was speaking with yesterday was talking about, several of their accounts that were actually had been growing quite quickly, were quite cash rich, but were in some sectors that might actually get exposed. So, one of which was in the recruitment sector. If you go and look at the KPMG survey at the beginning of this year, it was one of the reasons that created a sort of negative Nelly response to one of the monetary policy committee members in the Bank of England, because the survey basically says to recruiters, do you expect to hire more permanent people? Do you expect to place more temporary people? And anything over 50 is positive, anything below 50 is negative. And it's the lowest print over like 20 years, except for the pandemic and the financial crisis. So recruiters are
Wow.
not feeling particularly positive. And the reason is that they think, this is, we're going to get squeezed into this context. If you look at that as a leading indicator, ultimately those recruitment firms are sitting on cash and doing quite well at the moment. If you said to them, go to the market, borrow now, you've got a good credit score, you've got good EBIT, you're in a good place, they're probably going to say, no, I'm not going to go and borrow. But if this does turn into something a little bit more squeaky, then at that point, they're going to be going to market when they don't have cash, when the credit score might be this and their EBIT's not so great. But it's a very difficult decision to actually go and take on those additional costs when actually we're already under pressure. So I understand the dilemma in that space, but that's a sort of a positive place for preparedness.
Yeah, it also depends on what your long-term aims are, because I find that when we had disruptions, let's take COVID as an example, the businesses that were struggling were more ripe for being acquired because they were, fed up with the position they were in, they were worried about the long term, and they were willing to sell at a lower price. But that's only possible if there are other businesses out there that have the capital that enables that acquisition. And so part of this can be a planning side of, if you are going to, or you do want to go on an acquisition spree, having that or securing that capital now may enable it when there is a downturn. But that's probably the worst case scenario here.
Well, look, I mean, I go back to this point. You can't predict, you can just prepare. And in that context, and again, using a cash-rich entity as an example, who may or may not want to go and be really prepared in this context. At the moment, speaking to lenders over the last couple of days, the market is functioning absolutely normally. There's absolutely no change. Lenders are lending. They're lending on, the traditional pieces, EBIT, assets, whatever it is that's coming in. We are seeing the same volume of business today as we saw yesterday. There's no uptick, there's no spike. I think if we go back to, say, back into Q3, Q4 last year, what we were seeing at Capitalise was probably more growth oriented. It felt like the wind was in our sails a bit last year. I'm not talking about Capitalise, I'm talking about the economy. Like we're starting to
Yeah,
pick up. We've got a change. We've got a government with mandate. You know, we've got some energy. Obviously, we've had some 0.1% prints in GDP, and it feels a bit more anemic, and there's some harder times going on. That feels a bit more challenging. And so we've gone from kind of growth funding, I'm going to buy this asset, I'm going to hire these people, I'm going to do these things, to I've got an HMRC bill, I've got some arrears that I need to settle, I need to do this. So we've moved into a slightly tighter place from a funding dynamic. I would expect if there was more volatility and we have some challenges, what I would expect to happen is an increase in application number a slowdown in underwriting time, so the underwriter's spending more time thinking about what's happening, and then ultimately more declines because the EBIT numbers are starting to turn negatively, and that's kind of forward projecting what might be happening in the business and therefore affordability.
Yeah, and then that comes down to, as you said earlier, the sooner you get in, the sooner you can secure that, then the more preferable rates, the quicker the decision, the longer you wait, the more challenging that becomes. So don't,
And
I guess, for any business, don't let yourself get too close to that being a problem and you needing it.
and the thing that why do I often talk about these macro events? The reason is that we could sit here and think that the auction on Tuesday in the US is like has no relevance to us here in the UK. But if that event were to trip up, right, or the market moves that were starting to happen. So before this announcement yesterday, every asset was selling off. Every asset, gold, bonds, equity, commodities, everything. And what that means is that people are selling stuff to move into cash. Okay.
Yep.
That then causes like disruption in the markets, which causes fractures, which suddenly causes a Silicon Valley bank. And suddenly we've got a pickle, and suddenly the lenders are not lending. So what you think is an infinite right to go and access the market for capital because I'm a well-positioned, well-credit profiled business suddenly evaporates. And unless the government comes in and steps in with some government support, which I imagine they can't anymore because we don't have the
Well,
window.
that is the challenge, right? Now we've kind of, as a country, as a global economy, backed ourselves into a wall. We don't really have anywhere else to go. So if there is a downturn, as long as it's not something, I guess, like a pandemic, part of it is going to be we have to ride it and come out the other end. And so many countries are stretched financially that I see that being a challenge, being a problem. But let's talk about, or let's try and turn this into the positive. What can we do? What should we be doing as accountants? Like, how do we still help our clients? How do we make sure that they are well prepared for this? What should we maybe be doing more with them? And it'd be really good to get your thoughts and your insights on that, Paul.
Okay, well, why don't I position what will likely happen in terms of behaviour of businesses and potentially accountants, and then what we can do to make a difference so that we can turn the headwinds into tailwinds. Typically, like if we look at prior circumstances, not trade circumstances, but crises, let's say, what businesses will do, they'll do one of three things. 90% of businesses will do one of three things. They will just cut costs across the board. Okay, they'll cut sales and marketing, so no more business coming in. They'll slash R&D. They'll let valuable talent out the door. They won't buy any businesses, or they'll try everything. Right? They're like, new markets, new products. Let's sell this thing. Like that's the answer. Or what is probably 50, 60% in this category, they'll simply wait too long. They'll just wait to see what happens, and then they will be reactive, which is how you started this session. Okay, the 10% of businesses that actually go on and make a big difference are those that demonstrate balance sheet discipline. Okay, and what do I mean by balance sheet discipline? I think that we've touched on working capital. It doesn't have to be borrowing. You just need to make sure that you've got the working capital to be able to get through whatever might come, a rainy day pot, let's call it. And don't make assumptions that liquidity is always there. The second is price correctly. It doesn't mean that you've got to cut prices to discount and go into this space. It could be that it's not a crude 10% increase in prices across the board. It could be that some customers could take an increase and some customers might not, right? Topical in the accounting space. But the point being is that you can price appropriately. Be customer centric. That's really important. Lots of people will start to withdraw. If they've cut costs, they're not going to have the customer support. They're not going to provide the same service. If you simply maintain your service, right, and your customer centric approach, ultimately you will outperform peers who are stepping back the 90%. And if you're going to cut costs, don't just do like, right, every department give me 10%. Be really surgical about where it is. Dive into where is the ROI on each headcount, on each marketing spend, on each asset that you purchase. And so long as it's positive, then you should be investing in that space, not cutting. So ROI positive. So balance sheet discipline. So that's obviously what a business can do. But if they need help, they should be speaking to their accountants about it because there's an enormous amount that accountants can do. But crucially, and this is obviously a flying flag for me, is that the accountants should be looking at their own portfolios And if we sit here in a world, there's 100 businesses, some of those businesses may struggle through this time. You can go and spend 90% of your time with those businesses who are struggling. It might be the time to provide them the support that they pay for, but at the same time, make sure that you are defending your business, that you are balance sheet discipline, that you are focusing on where to deploy your capacity and your capital, and help the businesses that can help that purpose. Because the more you thrive, the better the business, the more businesses you can help.
Yeah, definitely. And I know that any disruption creates opportunity, and you shouldn't be, as a council, we're sometimes too nice. And we've been talking at many shows, there's been lots of conversations about the fact that we will give away support to help our clients because, ultimately we want them to succeed. But we are businesses, we do need to still make money, and we need to do that effectively. And if there are additional services your clients need, you should be charging them for it. And if you do that proactively enough up front, the impact is going to be much better for them because they'll be in a much better position. And so that deeper relationship engagement perspective is critical. But this is a tech webinar, tech podcast. So one of the key things that we should always be looking at is what technology should you have in place to maximize this. And something that I'm seeing, tools do really effectively is those that you can overlay over all of your client base, anywhere you've got access to that data that can give you some insights, be that financial, be that operational, even if it's just giving you some insights in how is the data moving. Are they stagnating? Are they moving into a cash negative position? Are their prices dipping? Are they making strategic decisions, as you say, Paul, that may hamper them longer term? And so, I guess from your side, Paul, do you think that those overlaying tools that generate the awareness of the accountant is something that they should, as a must now, have in place?
Yeah, I mean, I think to your point about the events, I think there's an enormous conversation about AI and all these kind of pieces. I think the success of accounting firms is the implementation of technology plus people, and we know that technology is going to come and um, processify and AI, our way up through the repetitive pieces. Really, the value is increasingly going to be the value between people, the relationships that we hold, the trust that you can defer, and the conversations that you can deliver. But that is built on a foundation of technology.
Yeah, it's an enabler. It enables those conversations, it enables that awareness, and that is a key focus for everyone. And as I'm as you've talked about the Capitalize platform, I'm a big advocate for making effective change. You said, the scalpel approach, and something that you should always be doing is thinking about, well, what can I bring in short term, quick, that will have that. I guess that positive outcome, make us more efficient, more dynamic, give us the information. And the only way you do that is by research, talking to the right people, and consulting ahead of any potential time. So if this is something where, if this is a period where you're thinking, oh, maybe I should defer those kind of projects, I'm of completely the other opinion. Bring them back and get awareness. Then you can make decisions whether you take the whole thing forward, part of it forward, and as you said, be very, very focused. Paul, any last words from you? Any last insight that you can relay to anyone that's listening to this on what maybe be the number one thing that they should do, not as reaction to tariffs, but maybe as something that they should have done already that this tariff thing should prompt?
I think look, I'm going to reiterate a statement, which is that uncertainty is the defining characteristic of the world in which we live. Okay, and in that context, head in the sand is not going to serve us well, because things are going to change. And if we embrace that change and we invest into that change, as you say, there is going to be great opportunity for everybody involved.
Thank you so much, Paul. Thank you for coming in and helping us wade through what is just chaos at the moment, in my opinion, and the potential impact that may have on us all. For anyone watching today, if you like like the show, please do comment. Reach out to Paul if you want any more information. I've learned a lot from the conversation today, Paul. So I may well be tapping you up in the future on anything that's economy based. And if you do want to make sure you catch more of this, please do like and subscribe to the Digital Disruptors channel, and look out for our post tomorrow in which we'll be sharing the new newsletter. So if you are used to getting this via your ears and via your eyes, you can also read it via your emails going forward as well. So please do reach out to that and like and subscribe, and we'll catch you next week on the next show. Thank you so much for joining.
Thanks, Ryan.
Cool. Thanks, Paul.
Do I need to do anything? You're